OpenAI had to revise their cost estimates for the next 4.5 years upwards by 250%, because if this had been a publicly traded company, the stock would have sold off by 90%. When the dust settles, whenever this bubble pops, there's going to be tens, if not hundreds of billions of dollars that will literally be incinerated.
In London, a quiet alarm bell just rang, and it came from one of the world's most cautious institutions. The Bank of England has issued a chilling warning. The artificial intelligence boom may not be a revolution, but a bubble waiting to burst. It begins like every great economic story with euphoria. Investors, corporations, even governments are swept up in the fever of AI, machines that can reason, algorithms that can create, software that promises to outthink humanity itself. But as excitement builds, so does a sense of déjà vu, because we've been here before. In the late 1990s, it was the dot-com dream. Startups with no profits, sometimes no products, raised billions on nothing but promises and buzzwords. Then came the crash. $1 trillion wiped out in months. And now, 2 decades later, the Bank of England is seeing the same pattern emerge again. The bank's Financial Policy Committee warns that on a number of measures, equity market valuations appear stretched, particularly for technology companies focused on artificial intelligence. In plain English, too much money is chasing too few real results. AI companies, from titans like OpenAI and Anthropic to countless startups, are being valued not for what they earn, but for what they might someday do. OpenAI alone, valued at nearly $500 billion, has yet to generate revenue at a scale that matches its valuation. Anthropic is worth $170 billion, 3 times more than last year. It's a modern-day gold rush. But gold rushes end. The danger lies in growing concentration. 6 companies, Nvidia, Microsoft, Apple, Alphabet, Amazon, and Meta, now make up about 30% of the total value of the S&P 500. That's the highest concentration in 50 years. What happens if even one of them stumbles? The global market could ripple or even collapse in ways eerily similar to 2000 or 2008. And it's not just financial exuberance that worries regulators, it's fragility. The Bank of England points to hidden bottlenecks, power shortages, data scarcity, and fragile supply chains for the rare materials needed to train and run large AI models. If any of these systems break down, the illusion of unstoppable progress could shatter overnight. Even the International Monetary Fund is uneasy. Its managing director, Kristalina Georgieva, warned that today's valuations are heading toward levels we saw during the bullishness about the internet 25 years ago. So what's really happening here? Part of the story is psychology, the human hunger for the next big thing. Every generation has its miracle. Railways in the 1800s, radio in the 1920s, the internet in the 1990s, and now AI, it's a technology so transformative that even its critics can't look away. But speculation often runs ahead of reality. Kate Lehman, chief market analyst at AvaTrade, notes that while AI's potential is enormous, the pace of investment over the last year has been dizzying, with valuations in some cases outpacing actual revenue or commercial maturity. Many AI companies today have massive valuations without sustainable profits, relying on endless investor enthusiasm. But Lehman also strikes a balance. She argues that AI is not just another tech trend, but a foundational shift that's still in an early growth phase. So which is it, bubble or breakthrough? The truth may lie somewhere in between. AI is undoubtedly transforming industries, from healthcare to education, finance to art. It's becoming the nervous system of modern civilization. But in the rush to profit, markets may have lost sight of the long game. There's an irony, too. The very algorithms that power AI are now helping to fuel the speculation around it. Trading bots, sentiment analyzers, and automated market tools driven by AI are amplifying hype cycles. Optimism feeds valuation, and valuation fuels more optimism. It's like a digital echo chamber for money. And if the echo breaks, a sudden correction, as the bank delicately phrases it, could shake not just tech investors, but the entire financial system. The bank warns that Equity markets are particularly exposed should expectations around the impact of AI become less optimistic. In other words, if the world stops believing in the AI miracle, trillions could vanish almost overnight. But here's the twist. Even if the bubble bursts, AI itself won't disappear. The dot-com crash didn't kill the internet, it refined it. Out of the wreckage came Amazon, Google, and a new digital age. Perhaps the same fate awaits AI, a painful correction that separates fantasy from future. Because beneath the speculation, real progress is happening. Machines are learning faster, data centers are evolving, and industries are being reshaped. The question isn't whether AI will change the world. It's whether investors and governments can handle the shockwaves when reality catches up to the dream. So, what do you think? Is this the dawn of a new industrial revolution or the calm before a trillion-dollar storm? Drop your thoughts in the comments below. I read every one of them, and if you want more deep dive stories that connect technology, history, and power, don't forget to like this video, subscribe, and turn on notifications because the next great turning point might already be unfolding.